Welcome to this tutorial. In this video, I'll be demonstrating how to calculate the marginal and absorption costing profit statements. Alright, to begin with, I'll begin by saying what the difference is between the two. The main difference between marginal and absorption costing method to profit statements approach is that the marginal costing only focuses on the variable production cost. And I emphasize, marginal costing focuses on the variable production cost, meaning only production costs that are variable in nature. So what we're discussing, we're not discussing any other costs like sales and distribution, administrative expenses. My main focus here is basically the production cost, because it's the way we're going to look at it is the way we differ in valuing the cost per unit. All right. So marginal costing, we only focus on the variable production cost. On the other hand, absorption costing, we absorb the fixed production, not any other fixed cost. The fixed production. We can have fixed selling, fixed administrative overhead costs. Those ones, we do not absorb them into a product, but we are only interested in the fixed production cost. All right. So let's look at how this works out. Here we have an example. As you can see, X limited budgeted information for the month of November 2023 is as follows. The selling price is $960. The variable production cost is $240. The fixed production overhead per unit is $300. The closing inventory for October 2023 was 100 units. So we are basically dealing with November 2023. So the closing inventory for October 2023 becomes the opening inventory for November 2023. Let's proceed. Okay. Fixed production overhead for the month of November were $624,000. Units produced in the month of November, of course, is 1,160 units, and the units sold is 1,140 units. The question comes, required, calculate the gross profit using marginal and absorption costing method. So I'm going to use two methods to calculate the gross profit, the marginal approach and the absorption approach. And then the examiner goes on to say, reconcile the profits calculated in part A. So we're going to prepare a reconciliation statement and see why the two profit figures had to differ at some point. So I'm beginning with marginal. So marginal statement, marginal profit statement. Remember, I said under marginal we only focus on the variable production cost. So like you can see here, this is the selling price. So the variable production cost is this one, and this one is the fixed production cost. So my cost per unit I have variable production cost. So my variable production cost is actually 240. So this is my cost per unit. if I'm using the marginal approach. So I have the cost per unit. Once I have the cost per unit, I can now start. I'll say sales, these are dollars. I can now say sales. So we'll come here, we'll see how many units were sold. Alright, 140 units were sold. And each unit is being sold at $960. Okay, so the sales will be, sorry, I'm phoned to Kwacha, it's my home currency. Let me be consistent. This should be $1. Okay, so 1,140 multiplied by $960, I have $1,094,400,000. Okay, $1,094,400,000. All right, and then we are going to take it the normal way we prepare the profit statements. How do we prepare the profit statements? It is basically sales minus cost of goods sold, and the cost of goods sold is calculated by saying opening inventory plus production or purchases minus closing inventory. That's how we calculate the cost of goods sold. Alright? Opening inventory plus purchases or production less closing inventory value, we have the cost of goods sold. Once we calculate the cost of goods sold, we remove them from the sales to get the gross profit. Let's see. So in this case, our opening inventory is basically, as you can see, 100 units there. Opening inventory, which was the closing for October, it's opening for November, 100,000 units. Now this is stock, so we value it at the cost per unit, and we've established to say our cost per unit is $240. So now this will be $24,000. All right. $24,000 as our opening inventory. Then purchases or production. Production is basically 1,160. At 240 as well. I have 278,400. All right, and then closing inventory. The examiner did not give us straight away what the closing inventory, but what we know for sure is opening inventory was 100 units. So if I have opening inventory 100 units, and then I produce the 1,160, together I have what I've produced plus what I opened with. So I have 100 plus 1,160. This will be 1,260. So altogether I've got 1,260 units, the opening plus what we produced. And then if that's what I had in November, I need to less what we sold. We sold 1,140. So minus 1,140 I remain with 120 units. That would be my closing inventory. Opening inventory plus what we produced, less what we sold. Okay, so closing, which was opening inventory plus what we produced, gave me 1260 minus what we sold is 120 at 240. All right, so 120 at 240, I have $28,800. Now when I do this plus that minus that, I have what is known as the gross profit under marginal. 24,000 plus 278,400 minus 28,800. I have 273,600 as my cost of goods sold. So that sales minus cost of goods sold, I have the gross profit here. Let me not call it gross profit because we are only removing variable cost, so I'll call it total contribution. So my total contribution, 1,094,400 minus 273,600, I have 820,800. Okay. From here now we'll say less fixed production overheads. These ones. $624,000. And then I can have my gross profit here, which is what the examiner is actually requesting me to calculate. I have 196,800 as my gross profit. So this is how we calculate the marginal approach to profit statement. We value the cost per unit at variable cost only, variable production cost only. Let's see how we calculate the profit using the absorption statement, where we absorb the fixed production overhead into a unit product cost. Okay, so now what am I going to do? Okay, so let me just keep the profit figure for marginal this side because I'll need to reconcile. Profit under marginal is 196,800. So I can remove this on the board and prepare the absorption approach to profit statement. All right, let me remove the word marginal there. We are replacing it with absorption. Absorption profit statement. There we go. Yeah, I have dollars there. I'll start the same way. No. First, I need to establish the cost per unit. The cost per unit. Remember, this one takes both the variable production cost and fixed production cost. So I have variable production cost. Variable production cost is $240, and then I have the fixed production cost, fixed production overhead cost per unit, which is $300. $300, and now the cost per unit is 540. Okay. Remember, in marginal we use the cost per unit 240. So this is what makes it a little bit different. So I have the sales there. I have the sales here. What were my sales? We sold 1,140 units. We sold them at $960 each. So the sales value will not change. Will still remain to be the same. 1,094,400. Okay. So that's my sales value. Then opening inventory 100 units, but this time around not at 240 but at 540, which is the cost per unit. This gives me 54,000, I guess. Absolutely. And then production or purchases. Production, we produced 1,160 at 540. $626,400. Closing inventory, we said closing inventory is 120. We know where the 120 is coming from. We said 100 plus the units produced less the units sold. Okay, so the closing inventory is 120, which is basically 100 plus units produced minus units sold. That gives us the closing inventory, which is 120, valued at 540 as well. I have the closing inventory being 64,800. Okay, 54,000 plus 626,400 minus 64,800. I have 600 as cost of goods sold. All right. From here now, I can find the gross profit before adjustment. I have 478,800. Now, this gross profit that I have is before adjustment because I need to adjust for over and under absorption. I need to see whether the overheads during these periods were over absorbed or under absorbed. So let me just do the over and under absorption just below here. Let's see whether the overheads were under absorbed or over absorbed, because the fixed production overheads that were incurred during the month was that. So we want to see if what we absorbed in this statement is more than what was paid for or less than what was paid for, so that we can make an adjustment to the profit figure. So I'll start absorbed. Now, the aspect of absorption comes in because the fixed production overheads have been absorbed into a unit cost. So it's this guy, which is the fixed production overheads, that we check for absorption, whether it was under absorbed or over absorbed. So the key guy here, like I mentioned, which makes the profit statement differ between marginal and absorption, is because of the fixed production cost that was absorbed as we were doing the absorption profit statement. So that's the key guy. $300 multiplied by the number of units which were produced, 1,160. $348,000 was the absorbed, and the actual is what? How much was spent? $624,000. So look here. If you observe carefully there, the absorbed is less than the actual. So we'll call this as the under absorbed, because the absorbed is less than the actual. If the absorbed was more than the actual, we would have said we over absorbed. So we under absorbed by how much? 348,000 minus 624,000. We under absorbed by $276,000. Under absorbed. Under absorbed by $276,000. So if you under absorb the fixed production expenses, in other words, for lack of a better term, I can simply say we underestimated the fixed production cost. So if you underestimate the cost, you know what you are doing? You are deliberately inflating the profit figure. You are deliberately increasing the profit figure. So if there was an under absorption of 276,000, it simply means that the fixed production costs were underestimated, and therefore they increased deliberately the the gross profit. So to correct this gross profit, we need to remove what was under absorbed, so that we bring it to the reality. Because in all essence, if you under absorb the cost, you are deliberately increasing the what? The profit, which shouldn't be the case. So this profit figure has to be adjusted so that it is reduced to the profit level it's supposed to be. So we are going to less under absorption. $276,000. So I shall call this as the adjusted profit now, which is the correct profit figure under absorption. So you see, absorption costing approach has got issues. You need to understand how to adjust for under and over absorption. So the profit figure is $202,800. That's the profit figure. All right? That's the profit figure. Now let's perform a reconciliation. I need the marginal profit. Marginal profit, I found 196,800, which is here. You remember this profit figure that we had found when we performed the marginal approach. So marginal profit. Marginal profit figure 196,800. Okay. Now I need to adjust, but before I can adjust, there's something that I need to talk about. Of course, we would have seen to say that the absorption costing method recorded a higher profit. That's what I want to justify. Why did the absorption cost method record the higher profit? And okay, or in what circumstances do we expect absorption costing method to record a higher profit figure than marginal? And the period when inventory is increasing. In the period when inventory is increasing. What do I mean by saying that? Remember, our opening inventory was 100 and our closing inventory is 120. So when you look at these two, during the period there was an increase in inventory of 20 units. Are we together? Now, why is it so that the profit figure for absorption will be higher? It's because of this closing inventory, which is less from the cost of goods sold. So if the closing inventory is higher, it simply means that the units that are escaping this period, they are escaping with the fixed production cost which was meant for this period, which is being transferred into the next period. So when I say absorption cost method will record a higher profit figure when there is an increase in inventory, this is what I basically mean. The opening inventory was 100, meaning we received 100 which had these fixed costs for the previous period. Okay? And then we transferred a 120 which has the fixed cost for this period into the next period. So in other words, we received less units and we transferred more units. So meaning we received less components of the fixed production cost from the previous period, and we transferred more units which are the 300 component into the other period, reducing the cost of goods sold for this particular period. I hope that is clear. So from there, any other student, if you've understood what I've explained here, it simply entails that in the event that inventory is increasing, absorption costing method is going to record a higher profit than marginal, because it transfers more cost into the other period than it received. Okay? So now, the biggest issue is actually the 20 units itself, the difference in opening and closing inventory. This is what causes the difference in what? In profits. Okay? So now, let's see how this is going to work out as I'm adjusting. Adjustment. The 20 units is the problem. We are the opening 100, closing 120, inventory increased by 20 units. So 20 units, which had this component, the fixed production cost, which is absorbed, okay, of 300. Alright. So now I can calculate 20 multiplied by 300 gives me 6,000. So there is a difference of 6,000 in what? In profit recorded between marginal and absorption. And we know for sure to say absorption recorded a higher profit than marginal. So if absorption recorded a higher profit than marginal, we are going to add. So when we add, we assume we are going to arrive at the absorption profit. Let's add there. 196,800 plus 6,000 $202,800. $202,800. This should have been our absorption profit. Is it true? Yes. There, the absorption profit is here. This and that is the same. So we have reconciled. Alright. So to sum it up, in the event when there is decrease in inventory, meaning the opening inventory is more and the closing inventory is less, marginal costing was going to record a higher profit, and for us to find for absorption, we are going to subtract because we expect absorption to have a lower profit. But in this event, where there was increase in inventory, we know to say absorption costing recorded a higher profit. So as we are adjusting the marginal, we have to add it back as the case could be. So this is how you do marginal and absorption costing profit statement approaches. Thank you so much.